Evening, I am starting the class now. So yesterday we discussed about standard and itemized deduction. So after deducting our standard or itemized deduction, we will get our taxable income. So depending upon the tax bracket we are coming in, like a taxpayer, according to their taxable income, tax rate is charged and you will calculate the taxable amount. Okay, so basic formula is this. First of all, you have gross income. From the gross income, you first have some adjustment, which is called above the line adjustment. After adjusting these items, you will get your adjusted gross income. From adjusted gross income, you can deduct either standard deduction or itemized deduction. Also, for individual taxpayer, you have a special kind of deduction also, which is qualified business income deduction. So after deducting these, we will get our taxable income. So depending upon the tax bracket we are coming in, we will calculate the gross tax liability. So next to gross tax liability, we have some credits which can give dollar for dollar reduction in liability. Means they can directly reduce our tax liability. And after getting some tax credit, we will have our net tax liability. Okay. These are the summary of what we have discussed yesterday about standard deduction and itemized deduction. So the US uses a progressive tax structure, means lower income amounts are taxed at lower rate, whereas if you have higher taxable income, then it will be charged at higher rates. Next is tax credits. Tax credit are basically the credits which can give dollar for dollar reduction directly in the tax liability. All the deduction you have studied earlier, these were deducted from your gross income or adjusted gross income, but these credits can be directly deducted from your tax liability. Okay, so generally we have two types of credit: non-refundable and refundable credits. So basically, non-refundable credit means which can reduce your tax liability to zero, not to negative. Okay. Like if you have some excess of credit, then it will not give you any refund. It will only reduce your tax liability up to the zero amount. Whereas refundable credit means which if you have your credits more than your tax liability, then these credit may get refund. Okay. So some of the examples are: non-refundable credits are child and dependent care credit, education credit, adoption credit. And refundable credit, AITC, additional child tax credit, American opportunity credit. AITC means earned income tax credit. So full tax computation, it is an example given related to how the tax is actually calculated. So first of all, you have your salary income $90,000, then interest income $2,000, student loan interest standard deduction. So you have to calculate the tax. So first of all, you will add this amount of income. Okay, then you have student loan interest. Student loan interest, you can get the deduction up to $2,500. That means you can reduce this amount from your gross income. Next, you have either itemized deduction or standard deduction. In this case, you are given only standard deduction. So that means you can deduct your standard deduction from your adjusted gross income to get the taxable amount. So depending upon the tax bracket, so we will generally apply the progressive brackets, like up to the 11,600 tax rate is 10%. So we will calculate our taxes on this amount. Then up to $35,550 we have 12%. Again, then remaining amount we have 22% of tax rate. So our total tax is $11,861. Okay. Next is credit application. So how will you apply the credit? So basically, there are certain credits you have available, like non-refundable and refundable. Depending upon the limitation, you can apply your credits. So for example, if your taxable income is $80,000 and number of children is two, then you have child tax credit, which is $2,000 for each child. Since there are two children, then means you can get $4,000 of child tax credit. So since credit are directly deducted from your tax liability, so first of all you will calculate your tax liability and then deduct these credits. Any doubt? Any doubt till here?
No.
Okay,
No,
so
ma'am.
okay, there this is the detailed explanation of tax credit. So tax credit directly reduce the amount of tax off, means directly reduce your tax liability. They are more valuable than deduction because deduction only reduce the taxable income, while credits directly reduce the tax liability. Okay, so tax credits are generally more valuable because they can directly reduce your tax liability, not your taxable income. Types we already discussed. You have two types of credits: non-refundable and refundable. Non-refundable credits are those which cannot generate a refund. Means if you have excess of credit, then your tax liability, then you may not get any refund. But refundable credit can give you the refund. So example of non-refundable credits are child and dependent care credit, education credit, adoption credit, foreign tax credit, elderly or disabled credit. So first is child and dependent care credits. So child and dependent care credits are basically the credit which are given if you have some expenses that is paid to a care for a dependent child under the age of 13 or disabled dependent or spouse. So if you require some care for your dependent child or disabled dependent, then whatever your expenses related to their care, that you can get the credit for these expenses. So maximum expense is up to $3,000 for one dependent and $6,000 for two or more. This credit is up to the amount of 20 to 35% of expenses. That means you can claim the 20 to 35% of your expenses as your credit. This is generally based on the your AGI. Maximum credit is 1,050 for one dependent and 2,100 for two or more. So depending upon your AGI, you can get this credit. Okay. So next credit is education credit. Means if someone is involved in some education program, either it is a degree, a full-time course or some part-time courses, then you can get some credits on this. First is American Opportunity Credit. So American Opportunity Credit is given for the college going student, means who are full-time working. They are doing some degree or from a recognized college or university. So they are eligible if someone is engaged in some program that gives them some degree from the recognized institution, then they get the American Opportunity Credit. So it is up to $2,500 for per student. 100% of first $2,000 plus 25% of next $2,000 of your expenses, you can get this as your credit in your form 1040. So generally it is 2500. How is it calculated? If you have your expense up to $2,000, then 100% of the expense can be taken as a credit. But if you have more than $2,000 of your expenses, then next $2,000 of expenses you can only claim up to 25%. That means 25% of 2000 means $500. So up to $2,500 you can get this credit. 40% credit is refundable. Okay, you can't get 100% of refund, but 40% refund you can get. It applies to first 4 year of post-secondary education. So if you are engaged in some degree program, then up to 4 years of your education, this is applied. Next is lifetime learning credit. So lifetime learning credit can be claimed by those like who are engaged in some part-time courses, not full-time. Means that program which usually do not lead to any degree, but instead of some courses which are actually to improve their skills. So if you have your expenses up to $10,000, then you can get 20% of credit on these expenses, means up to $2,000 is the credit that you can claim in your form 1040. This is a non-refundable, means you can't get any refund if you have excess of credit, and applies to unlimited years of education, means whenever you are doing some part-time courses, you can get this credit. Any doubt till here?
No.
Any doubt?
No, ma'am.
Okay. So next is adoption credit. Adoption credit means if someone is adopting a child, then all the expenses related to the child adoption, he or she can claim in form 1040 as a adoption credit, but certain like conditions are applied. For example, if you are adopting within the US, then you can get the credit for the expenses in the year the adoption is completed. But if you are adopting some foreign child, then the expenses can only be claimed if the adoption becomes the final. Okay, this credit can be taken in the year in which the adoption is final. But if you are adopting a US child, then if the adoption is not like occurred, even though you can claim your expenses, but if it is a foreign child, then you can only claim if the adoption becomes qualified. Amount is $16,810 per child, and it is non-refundable but may be carried forward up to 5 years. Next is foreign tax credit. So foreign tax credit is given if you are paying some taxes on the foreign income, then you can get this credit. The limitation to calculate how much like credit you can claim in your form 1040. This is the formula to calculate your foreign income divided by your total taxable income, means whatever the income you are getting, your whole worldwide income, and multiplied by US tax liability. So up to this limit you can claim in your form 1040. This credit can be carry back for 1 year and carry forward for 10 years. Next is refundable credits. So refundable credits means the credits which can reduce your tax liability below zero, means will lead to a refund if you have excess of credits. For example, your earned income tax credit. So earned income tax credit is primarily given for the individual which have low to moderate earned income. Okay, this is based on their filing status and number of qualifying children. So to claim this credit, you should have some earned income and generally have some qualified children. So depending upon your filing status and qualified children, you can get this credit. Okay. So for example, if someone is married and having two children, then up to this amount he can get the earned income credit. Okay. So next is child tax credit and additional child tax credit. So this is credit generally given for the dependent. So you can get up to the amount of $2,000 of child tax credit for qualifying child who is less than 17 years of age. Some phase out also applied, means if your income is exceeding some amount, then this credit will decrease in the amount depending upon the phase out limit. So this credit is partially refundable, means if up to $1,500 refundable portion. Okay. So hybrid credit already told you which is partially refundable. For example, American Opportunity Credit, which is 40% of refundable, and Child Tax Credit, which is $1,500 of refundable. Okay, any doubt till here? Generally, calculations are not asked in the exam directly. They can ask you about the credit which is refundable or which is not refundable. Any doubt till here?
No, ma'am.
Okay. So carry forward provision we already discussed, like in adoption credit, the carry forward we can carry forward for 5 years. If you have foreign tax credit, then it will be 1 year carry back and 10 years carry forward. General business credit, it can be carry forward for 20 years and 1 year's carry back. Then AMT credit, it has indefinite carry forward. So next is estimated tax and inadequate withholding. Estimated tax and inadequate withholding, basically as an individual taxpayer, you are required to pay your taxes at the estimated amount and on the particular dates. Up to the particular date, you have to pay your estimated taxes. But if someone is have not paid their estimated taxes or like paid less than their estimated taxes, then they have to subject to some kind of penalties. The US tax system follows a pay as you go principle, means you should pay the taxes as you are earning within the year. You do not have to pay the taxes at the end of the year. Instead, you have to pay in installment as you are earning your income. Taxes must be paid as income is earned either through withholding or estimated tax payment. Means if your employer is withholding your taxes, or if you're a self-employed person, then you have to pay your estimated tax payment. Failure to pay enough tax throughout the year can result in the penalties for the underpayment of estimated taxes. So first is who must pay estimated tax payment. So who should pay this amount? So if a taxpayer must pay estimated taxes if both the conditions apply, means they are expected to owe at least $1,000 after subtracting withholding and refundable credits. So if your tax is withholding by your employer, and even after withholding and refundable credit, you have your tax liability of $1,000 or more, then you have to pay your estimated tax to the IRS. Withholding and refundable credits are less than the smaller of 90% of current tax liability or 100% of the prior year's tax liability. So, if you're withholding and refundable credits, you need to pay your estimated tax payment at least 90% of current tax liability or 100% of prior tax liability. If your AGR is greater than $150,000, then this 100% will become your 110%. Okay, so you have to pay at least of this amount. Okay, which is smaller value, whichever is the smaller value, you have to pay up to the that amount. Okay, if you have not paid up to this amount, then you have to pay the penalty to the IRS. Who does not need to pay estimated taxes? So if your withholding is enough, and even after withholding your taxes, you do not have any tax liability, or you have your tax liability less than of $1,000. If you do not have any tax liability in the prior year, the prior year covered 12 months, and the individual was a US citizen or resident for the entire year, then in this case you do not need to pay any estimated taxes if you do not have any tax liability in the prior year. Okay, any doubt till here? Any doubt till here?
No, ma'am.
No.
Okay. So due date for estimated taxes, you have to pay your estimated taxes in your 4 installment. First installment should be April 15, then June 15, then September 15, and then January 15 of the next year. So you have to pay your taxes up to these date. If the date falls on weekend or holiday, then the payment is due to the next business day. For example, if on January 15 you have Saturday or Sunday or some holiday, then next working day will be your due date. So how are estimated tax is calculated? So your total expected tax liability, subtracting your, if you have some withholding and refundable credit, then you are left with the estimated taxes. Okay. So your estimated taxes should be up to 90% of your current tax liability or up to 100% of your prior tax liability. Penalty for underpayment. Uh, First, we discuss this example. Mr. Alex expects a tax liability of $10,000 for 2025 and $6,000 of withheld. So he have their expected tax liability is $10,000 and 6,000 is already withheld. That means he is left with $4,000. Since this amount is greater than the $1,000, then he should pay his estimated tax payment to the IRS. So this $4,000 should be paid in 4 equal installment. That means $1,000 each quarter. Okay. A penalty may apply when payment are less than the required. So this is the required amount. Penalty will be applied if you do not have paid this amount, or your tax liability after withholding or refundable is $1,000 or more. So if the payment are below the minimum, means with estimated taxes, and taxes owed after credit is $1,000 and more, then you have to pay the underpayment penalty. So penalty is calculated by using IRS interest rate into underpayment amount, means whichever amount you are left to pay, and days underpaid divide by 365. Exceptions to penalty means when the penalty is not applied when your tax due is $1,000 or less. Sorry, is less than the $1,000. So if your underpayment amount is less than $1,000, then the penalty will not applied. Or if the payment meet the safe harbor, means if you have paid enough like 90% of current year or 100% of prior year tax liability, then this penalty will not apply. If your underpayment is caused by some casualty, disaster, or unusual circumstances, then also penalty will not apply. If the taxpayer retired or become disabled in the current or prior year, then again penalty will not apply. Okay. So for example, if your prior tax liability is 20,000 and current is 25,000 and you have paid $22,000, then you need to calculate whether you have to pay any penalty or not. So the limit should be 90% of current year or 100% of prior year. 100% of prior year or 90% of current year, whichever is the lower amount. So if you calculate 100% of prior year, that means it will give you 20,000. And if you calculate the 90% of current year, it will give you 90. It will give you 22,500. So lower amount is the $20,000. Since you have paid 22,000, that means you have paid more than the required limit. That means you will not subject to any penalty. So some special rule for farmers and fishermen, they need to pay only up to the amount of 66.6% of current year's tax by January 15. Okay, if 2/3 of gross income is from farming or fishing. Withholding adjustment means to avoid any penalties, taxpayer may increase wage or pension withholding using Form W4 and make additional estimated tax payment before deadlines. That's how you can avoid your penalty if you have your lower tax liability or if your estimated payments are enough before the deadlines. So example is given, Mr. John had prior year tax $15,000 is the prior tax liability and current year is $20,000 and he is paid $17,000. So if we calculate 100% of prior year and 90% of current year, so which is the lower amount? This $15,000, since $17,000 is more than $15,000. That means he has paid amount greater than the 100% of prior tax year tax liability. That means he has met the safe harbor meet criteria. Therefore, no penalty will be applied, and his taxes dues are $3,000. Any doubt? Okay. Any doubt in credits and estimated tax payments?
No, ma'am.
Okay. Okay, then we discuss some questions. So first is the which is of the following is not a refundable credit? Which is a non-refundable credit? You have to tell. So which should be the right answer? Which is a non-refundable credit? Earned income credit, child tax credit, retirement saving contribution credit, excess social security credit.
Ma'am, C option.
Yes, correct. So option number C, retirement saving contribution credit is the non-refundable credit. Earned income, child tax credit, and excess social security paid is a refundable credit. Okay, next is which of the following is not a test for qualifying a child for the purpose of earned income credit? So when we calculate the earned income credit, which is not a qualifying test, age, resident, relationship, income, which is not a test for qualifying child.
Child's income.
Child's income, yes, correct. Okay. Next question is Madison and Nick Cause have two children, ages 8 and 10. Both children meet the definition of a qualifying child. The Cause family has adjusted gross income of $300,000. What is the amount of child tax credit on the couple's current year income tax return? So, what should be the amount of child tax credit?
4,000.
Okay. And other one, Shravani?
Yes, ma'am.
Okay. Child tax credit is given $2,000 for each children. So, since they have two children, it means the credit should be $4,000. Next is which of the following personal tax credit can offset tax liability but cannot result in a refund to the taxpayer. That means you have to tell which is not a refundable credit.
Ma'am, option B.
Earned income credit is a refundable credit. You have to tell which is not refundable.
Ma'am, A option.
Yes, correct. Lifetime learning credit is a non-refundable credit. It does not give you any refund if your credit exceeds the tax liability. Next question is the Wells family has three children. Which of the children listed below would be subject to kiddie tax?
Ma'am, C option.
Yes, correct. Since Wilson is a full-time college student and also supported by his parent, like he do not have any income of himself, he's supported by his parents. So all the unearned income will be subject to the kiddie tax. Next is which of the following statement is true regarding net investment income tax? Uh, I do not discuss this topic. I think you this will be given in your book. Actually, net investment income tax is 3.8% of the lower of taxpayers' net investment income or excess of modified AGI over a threshold amount. So correct answer should be C. I think you do not have studied this topic. It may be given in your book. So please go through it for once after this class. Okay. Next question is for the current year, Seth and Shalya intend to file a joint return. Seth expect to earn 35,000 in wages from his teaching job. So he have 35,000 wages. He is covered by university pension plan. Shalya is a volunteer at their son Stephen's school. In addition to the said income, they received a 500 in interest income and $50 in prize winning from a local radio contest. Each would like to make a deductible contribution to a traditional IRA for the current year. They also believe that they will be eligible to claim a tax credit for this contribution. So, which of the following would both be eligible to do? So, they have their wages, their interest income, prize winnings, and they want to have some deductible IRA, which is traditional IRA, and they also like believe that they can earn some tax credit for this contribution. So, which of the following will be eligible for them?
Option D.
Okay, and other one. So, since they are contributing to the IRA, traditional IRA, therefore they can get the deduction, which is above the line deduction. Okay. Also, they have their retirement saving plan. They can also get a tax credit on this amount. So, answer should be D. They can claim both deductible IRA contribution and tax credit. Okay. Next is important question. Don White's adjusted gross income for year one is $100,000, and for year two, the minimum payment required to avoid the penalty for the underpayment of taxes should be. So their adjusted gross income for year one was given. This amount covered 12-month period. For the year two, the minimum payment should be which to avoid the underpayment of estimated taxes. So if you want to avoid underpayment of taxes, then what should be the estimated amount of tax?
Option B.
90% of current year.
Option B. 90% of current year or 100% of last year.
Yes, it should be lower of the amount, 90% of current tax liability or 100% of prior tax liability. Okay. So why not 110%? Why not 110%?
It is 100%.
110% will be applied if prior year AGI is more than $150,000. Since they have only $100,000 of AGI in prior year, that means 100% of prior year limit will be applied, not 110%. Okay. So correct answer should be B. Any doubt in this question?
No, ma'am.
Okay. Next is an employee who has social security tax withheld in an amount greater than the maximum for a particular year may claim. So if he has some social security tax withheld greater than the maximum, so what he can do? Means withholding is greater than the estimated amount. Will you get the refund or not? Or will the excess credit, uh, will you get the excess of the taxes as credit or not? So if someone has social security tax withholding more than the particular amount, like more than the maximum amount for the particular year, then excess of these amount can be taken as a credit. Okay, so correct answer should be C. So if the withholding for social security taxes is more than the required amount, then excess can be claimed as credit. Okay. Any doubt in this question?
No.
I think
No, ma'am.
this topic will be given in your book. It was not in the presentation, I think, PDF. So are you studying from this PDF or from book?
From the PDF.
But please study from book also, because
Hmm.
yes, some small topics will be given in your books, which is not in this PDF. Next is, which of the following statement about child and dependent care credit is correct? Child and dependent care credit. So the child
Option
must be a direct descendant. Credit is available for cost of care. Maximum credit is $600 or should be under the age of 18 years.
option D, under the age of 18 years.
Ma'am, option B, the credit is available for the cost care of disabled spouse.
Yes, correct. Correct answer should be B. It is available for the expense of a care of any dependent or a disabled spouse. Or age limit is 13 years, not 18 years. Okay, so correct answer should be B. Okay. So any doubt in these questions?
Okay.
Okay, this was all about your Form 1040 individual taxation. So I will suggest you to read from book once and then start practicing some questions. Okay, so if you want to have one more class for the practice, then I can take. Otherwise, I will start the next unit from next class.
Okay, ma'am.
You can start next unit probably.
Next unit or practice session.
Next unit.
Okay. Okay, then we will discuss the next unit in next class. Okay. Okay, if you have any doubt in the 1040 individual taxation, then you can ask from gross income, from above the line deduction, or standard or itemized deduction, or credits. Any doubt in this topic?
We'll go through once all the PDF for 1040, and then if any, then we'll ask.
Okay, sure. Any doubt in this PDF?
No, ma'am.
And Dhanashri? Okay, then if you have
No
any doubt,
problem.
please read for once. If you have any doubt in any question or any topic, then please ask in the next class, or you can ask now if you have.
Let me revise the topic of 1040, and if any questions is there, we'll ask in the next class.
Okay, then. Okay, then revise and you can ask in next class.
Yes, ma'am.
Okay.
Yeah.
Okay, bye.
Bye
Thank you,
bye.
ma'am. Bye.
Bye.
Welcome.